On 90 days, $847 billion in debt, double the interest rates, John A.G., the collapse files. The largest debt reset of the decade is not a prediction, it's scheduled. Here's what happens next. In 1982, Mexico announced it could not make an $80 million interest payment on its $80 billion foreign debt, a payment representing just 0.1% of the total owed. This single missed payment triggered the Latin American debt crisis, forcing 16 nations into default or restructuring within 18 months. The problem was not the $80 million. The problem was that admitting inability to pay one payment revealed inability to pay any future payment. The entire debt structure was exposed as unsustainable the moment the first domino fell. Today, between March and June 2026, approximately 90 days from now, over $847 billion in U.S. corporate bonds and commercial real estate loans mature and require refinancing. This represents the largest quarterly debt maturity in modern financial history. Companies and property owners that issued this debt at interest rates of 2 to 4% during 2020-2021 must now refinance at rates of 6 to 9%, effectively doubling or tripling their interest expense. Unlike 1982, no single entity will announce default. Instead, thousands of borrowers will quietly discover that debts issued when money was free cannot be serviced when money costs 6%. When the largest concentrated debt maturity in history coincides with interest rates triple those at issuance, and when this convergence occurs across corporate America and commercial real estate simultaneously, what does history reveal about whether such resets unfold as orderly refinancing or as cascading recognition that the debt was never sustainable at any realistic cost of capital? For most of history, debt maturity was not a systemic risk because debt itself was constrained by physical realities. To lend, one needed actual wealth: gold, silver, grain, land. To borrow meant pledging collateral worth more than the loan, or demonstrating income sufficient for repayment. Debt that could not be serviced was simply not issued at scale because lenders risked their own wealth rather than created money. In medieval Europe, sovereign defaults occurred frequently. The Spanish crown defaulted 6 times between 1557 and 1647, but each default was discrete. The Spanish king borrowed from Italian banking houses, pledging future silver shipments from American mines as collateral. When silver production fell short or wars consumed the revenue, the king defaulted. The creditors lost fortunes. But the damage was contained to those who had chosen to lend. The broader economy was largely unaffected because most commerce operated on cash or barter, not credit. The critical constraint was that a lender who suffered losses could not continue lending. The Bardi and Peruzzi banking houses collapsed in the 1340s after England's Edward III defaulted on massive war loans. Their collapse did not trigger a credit crisis across Europe because credit was not the foundation of commerce. Most economic activity continued using commodity money, silver and gold coins, that required no counterparty trust. The 19th century saw the emergence of bond markets and corporate debt, but maturity schedules were staggered across decades. A railroad company might issue bonds maturing in 1875, 1880, 1885, spread across time, so that all obligations never came due simultaneously. If a single maturity could not be refinanced, the company might default on that series of bonds while continuing to service others. Concentrated maturity risk, the possibility that vast amounts of debt would come due in a brief period, did not exist by design. The Great Depression revealed what happens when maturity concentration meets inability to refinance. During the 1920s, corporations and municipalities issued bonds expecting to refinance at maturity using proceeds from new bond issuance. When credit markets froze in 1930 to 1933, maturing bonds could not be refinanced. Borrowers faced a choice: pay in full from operating cash flow, impossible for most, default, or frantically liquidate assets to raise cash. The wave of forced asset sales pushed prices lower, creating losses that caused more defaults, tightening credit further. Over 9,000 banks failed between 1930 and 1933, many holding corporate and municipal bonds that defaulted when maturity came and refinancing was unavailable. The default rate on corporate bonds reached 16% in 1933. Municipal defaults exceeded 4,000 across the nation. The scale was unprecedented because the integration of credit markets meant that a freeze in one sector, bank lending, instantly prevented refinancing in all sectors, corporate, municipal, real estate. The lesson was clear but subsequently forgotten. When large amounts of debt mature simultaneously, the system depends entirely on refinancing capacity. If credit is freely available, maturity is routine. If credit tightens or costs surge, maturity becomes crisis. The difference between sustainable and catastrophic is not the debt itself, but whether it can be rolled over at tolerable cost when the moment arrives. The The modern debt maturity wall emerged from structural changes in how corporate and real estate debt was issued following the 2008 financial crisis, accelerated dramatically during the COVID pandemic response. Following 2008, the Federal Reserve cut interest rates to near zero and maintained them there for 7 years. This created incentive for corporations to issue massive amounts of debt. A company could borrow $1 billion at 3% interest, costing $30 million annually, and use the proceeds to buy back stock, acquire competitors, or fund operations. Refinancing was assumed to be routine. When the bond matured in 5 or 10 years, rates would presumably be similar, allowing rollover with minimal cost change. From 2009 through 2019, U.S. corporations issued over $9 trillion in bonds. Approximately 60% of this was used not for productive investment, but for financial engineering, buybacks, dividends, and mergers. The debt served to extract value from companies and transfer it to shareholders and executives, rather than building capacity to service the debt through improved operations. This was rational in a zero-rate environment where capital was free and equity valuations depended on shareholder returns. But it created vulnerability. Earnings did not grow proportionally to debt, meaning debt service capacity was constrained if rates ever normalized. The COVID pandemic triggered even more extreme behavior. In March 2020, credit markets froze as pandemic uncertainty caused investors to refuse corporate debt regardless of price. The Fed intervened with unprecedented aggression, not just buying treasury bonds, but purchasing corporate bonds directly, including junk-rated debt. This intervention sent an unambiguous signal. Corporate debt would not be allowed to default. The Fed would intervene to prevent it. Corporations responded by issuing $2.3 trillion in bonds during 2020-2021, taking advantage of Fed suppressed rates that fell to 2% for investment-grade debt and 4% even for high-yield issuers. Commercial real estate followed identical dynamics. Property owners could borrow at 3% against office buildings or retail properties, assuming that rental income would cover debt service and that refinancing at maturity would be routine. Over $400 billion in commercial real estate loans were originated in 2020-2021 at these ultra-low rates, much of it with 5-year maturity structures, bringing it due in 2025-2026. The assumption underlying all of this issuance was that interest rates would remain permanently low. Fed officials through 2021 insisted inflation was transitory, and that rate increases would be modest and distant. The market believed them, or at least acted as if it believed them, issuing debt as if 2% to 4% rates were the permanent new normal. Then inflation surged to 9% in 2022, forcing the Fed to raise rates from 0 to 5.25% in 18 months, the fastest tightening in 40 years. By late 2023, investment-grade corporate bonds yielded 6% and high-yield bonds yielded 9%. Commercial real estate loans, when available at all, carried rates of 7 to 8%. The cost of capital had tripled from the rates at which the 2020-2021 debt was issued. This created the maturity wall. Over $2 trillion in corporate bonds mature between 2025 and 2027. Approximately $1.2 trillion of commercial real estate loans mature in the same period. The concentration is extreme. More debt matures in these 3 years than in the entire preceding 5 years combined. And all of it must be refinanced at rates double or triple the original issuance rates. The mechanics are straightforward. A company that issued $500 million at 3% in 2021 pays $15 million annually in interest. If it refinances at 6% in 2026, interest expense rises to $30 million annually, an extra $15 million that must come from operating cash flow, reduced investment, asset sales, or equity issuance. For a marginally profitable company, this doubling of interest expense can mean the difference between survival and insolvency. For commercial real estate, the math is even more brutal. A property purchased for $100 million with a $70 million loan at 3% generates $2.1 million in annual interest expense. If property values have fallen 30% to $70 million, as has occurred in office and retail sectors, the owner has zero equity. Refinancing the $70 million at 7% raises interest expense to $4.9 million. If the property generates $5 million in net operating income, virtually all income goes to debt service, leaving nothing for maintenance, vacancies, or ownership return. The property becomes financially unviable, forcing default or distressed sale. The concentration of maturities in Q2 2026, March through June, creates systemic risk. If $847 billion in debt matures in the single quarter, credit markets must absorb either $847 billion in refinancing demand or $847 billion in defaults and asset liquidations. Historical precedent suggests markets cannot smoothly absorb concentrated stress of this magnitude. Instead, the initial defaults or refinancing difficulties create panic, tightening credit for all borrowers, forcing more defaults, creating a cascade. The quantitative evidence of the impending debt maturity crisis is visible across corporate bond markets, commercial real estate loan data, and credit market conditions that will determine whether the $847 billion maturing in Q2 2026 can be refinanced or must default. Corporate bond maturity schedule. Total U.S. corporate bonds outstanding as of late 2025, approximately $11.3 trillion. Of this, $847 billion matures specifically in Q2 2026, March-June. The quarterly maturity schedule shows Q4 2025, $412 billion Q1 2026, $523 billion Q2 2026, $847 billion Q3 2026, $631 billion Q4 2026, $509 billion. The Q2 2026 maturity is more than double the typical quarterly maturity of $350-400 billion. The concentration reflects the massive issuance in Q2 2021, over $900 billion issued that quarter alone, when Fed intervention was most aggressive, with most bonds issued at 5-year maturities. Interest rate. Differential. Average coupon on bonds issued in Q2 2021, 2.9% for investment grade, 4.2% for high yield. Current refinancing rates as of late 2025, 6.1% for investment grade, 8.8% for high yield. The differential, 210 basis points for investment grade, 460 basis points for high yield, translates to massive interest expense increases. For the $847 billion maturing, approximately $620 billion is investment grade, refinancing at 6.1% versus 2.9% issuance, versus $19.8 billion additional annual interest expense. Approximately $227 billion is high yield, refinancing at 8.8% versus 4.2% issuance. It's $10.4 billion additional annual interest expense. Combined, over $30 billion in additional annual interest expense for this single quarter's maturities. Corporate ability to service higher costs. S&P 500 companies collectively generated approximately $2.1 trillion in operating income, EBITDA, in 2024. Interest expense was approximately $420 billion, representing 20% of operating income, already elevated by historical standards of 15 to 18%. Adding $30 billion annually from just the Q2 2026 refinancing increases the ratio to 21.4%, approaching the 22-25% levels associated with default waves. But the aggregate masks severe variation. Approximately 15-20% of public companies are zombies, generating insufficient cash flow to cover interest expense even at current rates. These companies survive only through access to refinancing or new borrowing. When rates double, their interest coverage ratios fall below 1.0, meaning operating income cannot cover interest expense. Default becomes inevitable unless equity is raised or assets are sold, both difficult when markets perceive distress. Commercial real estate maturity. Wall. Total commercial real estate loans outstanding, approximately $3.1 trillion. Of this, approximately $380 billion matures in Q2 2026, concentrated in office and retail properties. Property value deterioration. Office properties down 35-50% from 2019 peaks in major urban markets. Retail properties down 25-35%. Industrial warehouse, relatively stable multifamily, down 10-15%. Loan to value ratios at origination 2020-2021, typically 65-70%. With property values down 30-40%, current LTV ratios often exceed 100%, meaning debt exceeds property value. Refinancing requires either owner equity injection to reduce loan amount or lender willingness to maintain loan despite insufficient collateral. In tightening credit conditions, neither is reliable. Example, a $100 million office property purchased in 2021 with $70 million loan at 3%. Property value falls to $65 million. Owner has negative equity of $5 million. Refinancing the $70 million at 7% is rejected by lenders because LTV is 108%. Owner must inject $10 million equity to reduce loan to $60 million and achieve viable 92% LTV or default. Most owners facing this calculation default rather than inject equity into properties with negative value. Credit market capacity to absorb. Total corporate bond issuance in 2024. Approximately $1.45 trillion for the full year. Quarterly average, $360 billion. Q2 2026 maturity requiring refinancing. $847 billion in corporate bonds, plus $380 billion in CRE loans, $1.23 trillion total debt needing refinancing in a single quarter. This is 3.4 times the normal quarterly issuance capacity. Even if all normal issuance is displaced, unlikely, markets must absorb triple the normal volume. Historical episodes of refinancing stress show that when supply exceeds normal absorption capacity by 50 or 100%, credit spreads widen sharply, yields rise 100, 200 basis points, weaker credits are shut out entirely, and default waves begin. Bank lending capacity. Banks hold approximately $2.6 trillion in commercial and industrial loans and $3.1 trillion in commercial real estate loans. Bank loan balances have been contracting, down $127 billion in C&I loans from peak. Banks are simultaneously tightening lending standards, 18 consecutive quarters, and facing deposit outflows that reduce their capacity to fund new loans. Banks that would normally provide bridge financing or refinancing for maturing corporate debt and CRE loans are constrained. Many regional banks hold large CRE portfolios that are underwater, reducing capital available for new lending. The banking system is a less reliable refinancing source than in prior cycles. Default projections. Credit rating agencies project corporate default rates rising from current 3.8% to 5.5 to 6.5% in 2026. This implies 6 to 7% of the high-yield universe, approximately $120 billion, will default. But these projections assume smooth refinancing for most investment-grade debt. If refinancing access tightens significantly, defaults could spike toward the 8 to 10% range seen in 2008-2009, implying $140-180 billion in defaults. Commercial real estate default projections are less precise due to opaque private markets, but distressed CRE asset sales have already reached $45 billion in 2024, up from $12 billion in 2022. Projections suggest distressed sales could reach $80-100 billion in 2026 if refinancing remains difficult, implying default or forced restructuring on 7 to 8% of maturing CRE loans. The approaching debt maturity wall is sending signals through credit markets, equity markets, and corporate behavior that reveal how participants are pricing the refinancing risk. Credit spread. Widening. Investment-grade corporate bond spreads over treasuries have widened from 90 basis points in early 2024 to 145 basis points in late 2025. High-yield spreads have widened from 320 basis points to 485 basis points. This widening indicates investors are demanding higher compensation for credit risk, pricing in elevated default probability as maturities approach and refinancing becomes more uncertain. Particularly telling is the curve of credit spreads by maturity. Bonds maturing in 2026-2027 trade at wider spreads than bonds maturing in 2028-2030, creating an inverted credit spread curve. This inversion signals that near-term refinancing risk is priced as higher than longer-term fundamental credit risk. The market is specifically pricing the maturity wall. Equity market divergence. Highly leveraged companies, those with debt exceeding 4 to 5 times EBITDA, have underperformed the broader market by 18 percentage points in 2024-2025. This underperformance reflects equity investors' pricing in the refinancing risk and potential dilution if companies must raise equity to pay down debt or fund higher interest costs. Financial sector stocks, particularly regional banks with large commercial real estate exposure, have underperformed by 25 percentage points. This signals investor concern about credit losses banks will face when CRE loans mature and cannot be refinanced, forcing defaults that create loan loss reserves and capital erosion. Corporate behavior. Companies facing 2026 maturities have begun taking defensive actions, visible in earnings calls and securities filings, asset sales, companies selling non-core assets to raise cash for debt paydown equity issuance. Several companies have issued stock to reduce leverage preemptively, credit line drawdowns, increased usage of revolving credit facilities to build cash buffers, dividend cuts, some companies reducing or eliminating dividends to preserve cash, CapEx reduction, investment spending cut to divert cash to debt management. These actions are individually rational but collectively contractionary. Asset sales push prices lower, equity issuance dilutes shareholders, credit line usage reduces bank capacity for other borrowers, dividend cuts reduce investor income, CapEx cuts reduce future growth. When hundreds of companies act similarly, the aggregate effect is economic slowdown that validates the initial caution. Real estate signals. Commercial real estate transaction volumes have collapsed, down 65% from 2021 peaks. This reflects both buyer hesitation due to uncertainty about property values and seller reluctance to realize losses. The bid-ask spread, the gap between what sellers want and buyers offer, has widened to 20 to 30% for office properties. This wide spread prevents transactions and price discovery, creating uncertainty that further restricts refinancing as lenders cannot determine collateral value. Distressed property sales, foreclosures, short sales, loan workouts are accelerating. These transactions occur at 40-60% discounts to prior valuations, establishing new price comps that force mark-to-market losses on similar properties held by banks and investors. Derivatives, market signals, credit default swaps, insurance against corporate defaults have seen premiums rise sharply for companies with significant 2026 maturities. Interest rate swap markets show elevated demand for hedges protecting against rising rates, but also show basis risk, where companies cannot fully hedge refinancing risk because swaps cover rate movements, but not credit spread widening or refinancing availability. All signals converge on a single message. Credit markets are pricing significant refinancing stress and elevated default probability for the Q2 2026 maturity wave. The pricing is not panic. Credit still flows. Spreads have not reached 2008 crisis levels. But the steady widening and defensive positioning indicates market participants see material risk that the $847 billion maturity cannot be smoothly absorbed. Historical precedent for concentrated debt maturity walls provides clear patterns of how such events unfold when refinancing capacity proves insufficient. The 1982 Latin American debt crisis began with Mexico's announcement it could not service $80 billion in debt. Within 18 months, 16 nations defaulted or restructured. The cascade occurred because the same banks that lent to Mexico had also lent to Brazil, Argentina, Chile, and others. Losses on Mexican debt reduced bank capital, forcing reduction in lending to all emerging markets. Countries that might have refinanced normally could not, causing their defaults, causing more bank losses, tightening credit further. The U.S. savings and loan crisis of 1986 to 1991 involved $150 billion in commercial real estate loans made at low rates that could not be refinanced when rates rose and property values fell. Over 1,000 S&Ls failed. The Resolution Trust Corporation was created to liquidate assets, which took 5 years and realized losses of $40.50% on distressed properties. The slow liquidation prevented immediate market collapse but depressed real estate prices for years. The 2008 financial crisis included a maturity wall component. Bear Stearns and Lehman Brothers faced massive short-term debt maturities that could not be rolled over when counterparties lost confidence. Both failed within months of facing refinancing difficulties. The lesson: when maturity comes due and refinancing is unavailable, default follows rapidly regardless of asset quality or long-term viability. For the current situation, the Q2 2026 maturity wave will likely unfold in stages. Stage 1, Q1 2026. Selective stress. Investment-grade companies with strong cash flow will refinance successfully, though at higher cost. High-yield companies and weak investment-grade credits will face difficulty. Some will negotiate extensions with existing lenders. Some will issue equity to pay down debt. Some will sell assets. This stage involves individual company stress, but not systemic crisis. Stage 2, early Q2 2026, market tightening. As the volume of refinancing attempts peaks, credit markets will struggle to absorb supply. Spreads will widen sharply, potentially 100-200 basis points over current levels. Weaker credits will be shut out of markets entirely. Banks will tighten lending standards further. The number of companies unable to refinance will become visible, likely reaching dozens of public companies and hundreds of private firms. Stage 3, mid-Q2 2026. Default wave companies that cannot refinance will default or enter distressed restructuring. Credit rating downgrades will cascade as defaults cause contagion reassessment. High-yield mutual funds and ETFs will face redemptions, forcing asset sales that push prices lower. Banks will increase loan loss reserves, reducing earnings and capital. The default rate will spike toward 8-10% for high yield, with total defaults potentially reaching $150 to $200 billion across corporate and CRE. Stage 4, late Q2, Q3 2026, economic spillover. Corporate defaults trigger layoffs as companies restructure, consumer spending falls, business investment contracts. Banks tighten lending to all sectors, not just stressed corporates and CRE. The credit contraction that began in specific sectors becomes economy-wide. GDP growth slows or contracts, unemployment rises. The feedback loop between defaults, credit tightening, economic weakness, and more defaults becomes self-reinforcing. Stage 5, Q4 2026 to 2027, policy response. The Federal Reserve will likely respond with rate cuts and potentially renewed QE focused on corporate credit markets. Government may create facilities to provide bridge financing or loan guarantees. These interventions will prevent complete systemic collapse but cannot eliminate the fundamental problem. Debt issued at 2 to 4% cannot generate returns sufficient to service it at 6 to 9%. Intervention can delay defaults, but requires either inflating away debt through currency debasement or accepting years of zombie companies surviving on policy life support. The magnitude of consequence depends on contagion. If defaults remain concentrated in truly weak companies and distressed properties, losses might total $200, $300 billion. Painful but manageable for a $28 trillion economy. If contagion spreads to investment-grade credits through confidence loss and credit market freezing, losses could reach $500 billion to $1 trillion, rivaling 2008 in severity. In 1982, Mexico's inability to pay $80 million revealed that $80 billion in debt was unsustainable. The small payment was not the problem. The problem was that admitting inability to pay any amount destroyed confidence that any future payment could be made, triggering cascade across all emerging market debt. 90 days from now, $847 billion in corporate bonds and commercial real estate loans mature. Companies and property owners who issued this debt at 2 to 4% must refinance at 6 to 9% or default. This is not a liquidity problem that can be solved with short-term credit. It is a solvency problem. Debt that was marginally sustainable at 2% interest is mathematically unsustainable at 6% for companies and properties where earnings have not tripled. The signals are visible in credit spread widening, equity underperformance of leveraged companies, corporate defensive actions, and real estate transaction collapse. Markets are pricing material refinancing stress and elevated default probability. The scale, $847 billion in one quarter, exceeds normal market absorption capacity by over 200%. History provides precedent. Latin American crisis, 1982, S&L crisis, 1986, 1991, 2008, financial crisis all involved debt maturity walls where refinancing proved impossible. Each resulted in defaults, credit contraction, economic recession, and policy intervention. The current maturity wall is larger in nominal terms than any prior episode and occurs with corporate debt levels already at record highs relative to GDP. The countdown is not to a single event, but to a quarter where the accumulated consequences of zero-rate policy, massive debt issuance, and assumed permanent cheap money converge with reality. Money is not free. Debt costs 6%. And obligations issued on false assumptions must be restructured or defaulted. The 90 days represent the time remaining before this abstract recognition becomes concrete through hundreds of individual refinancing failures. This is not prediction. This is observation of scheduled maturities, current refinancing rates, and corporate cash flows that collectively reveal mathematical unsustainability. The largest debt reset of the decade is not a possibility contingent on economic conditions deteriorating. It is a certainty scheduled on calendars, encoded in bond indentures, and approaching with mechanical inevitability. The only questions are magnitude and contagion, not whether the reset occurs, but whether it remains contained or becomes systemic. 90 days, $847 billion. Double the cost of capital. The numbers are known. The pattern is historical. The countdown has begun.